This is important. So we're going to talk about taxes, right? And I want to invite Yulia Makarian out here to the front. So just a little bit about them. We've empowered business owners to gain comprehensive understanding of their financials, enabling them to make well-informed decisions about strategic initiatives. This commitment to transparency and financial clarity has yielded remarkable results, with business transition from generating thousands of dollars to achieving millions in revenue. So Yulia's, I was looking at her PowerPoint, and I'm like, wow. First of all, I've gone through a lot of these things, and some of the stuff, I'm looking at the slides, I'm like, okay, yes, this is good. I've done this, and then anyway, so what you're gonna share is very important. So I hope you guys enjoy it and take notes. Let's welcome Yulia.
So I'll start with the testimony. 2 weeks ago, I got very sick. But I kind of thought, okay, I have 2 weeks to get better. Then Mondays comes, and I can't talk, period. And then the Tuesday comes, and I'm not getting better. And Wednesday, my voice barely, cracking through. And then Alex calls me. And I said, Alex, I'm praying for God to give me voice back. Otherwise, I'll be just pointing. And Alex blessed me. And Thursday comes, and I can talk. And so, my voice is still a little bit cracky, but thank God, now I can read the poem. No, I'm just kidding. I know I've heard Alex said that 35% poetry in the Bible. So I think it's super important. So I will be talking about one of the favorite topics of mine. And I know one of the question was about the accountants, right? I never heard that you have to change the accountant every 3 years. What I do know for sure, and that most of the business owners, what they do is obey that rule, is to hire auditor. I will tell you a personal story that year ago, I became a CFO for the big company, and 1 month later, former CFO committed suicide. It was shock. But why? Because over 20 years, nobody ever checked the books. And as soon as I came, I started checking stuff, and she knew that there is stuff that I will find. And as a result, at age 63, she killed herself. So one of the rules that all the business owner needs to do, hire auditor every 3 to 5 years, even though you are not planning to borrow money. Because typically, business owner hire auditor if they planning to borrow money. Can somebody teach me how to use that? Oh, okay, that's a different clicker. And where am I clicking? Is it not working? Swipe this way or up? Okay. So, accountant doesn't mean that I can count, but it does. I can add 2 plus 2. But the majority of my work is actually analytical and remembering a lot of tax and governmental regulation like GAAP and other stuff. So one of the typical questions that I get asked, how can I not pay any taxes, right? I don't want to pay any taxes. And I always have this meme in mind that I want to share with you. Okay. You don't have income, you don't pay taxes. That's simple. So, yeah, that I'm not sure if you guys will like that, but that's what it is. And I want to jump in the presentation, and something that is dear to my heart is the statistics. I like to look at the numbers, statistics, they tell the story. And something I wanted to share is that we're right now complaining about the tax rates, right? Look at the 1944. Who remembers what happened in 1944? Depression, World War II was happening. All the resources was drained. And so at that time, government got together and they said, okay, we need to pour more money into that war so we can finish that war, right? And so they increased the tax rate to up to 94%. If you generated over $200,000 at that time, which is approximately, I believe it's like around 3.5 million in current rate, you would pay 94% in tax rate. When you were lower income, you would pay, it just turned, you would pay 23%. Anyway, moving forward, in 1967, like for the 19 years it stayed, right? And then in the 1976, it dropped to 70. Then our wonderful government, actually specifically Reagan, 1981, where it started significantly dropping. This is individual tax rate, okay? It's not the corporation tax rate, it's an individual tax rate. So if we look, the reason I put it 2003, that's when I moved in the United States. And so that's what was my tax rate here, my first tax rate. The tax rate, the maximum tax rate was 35, then it decreased to 39.6. And currently, Trump in 2018 did the revision of the tax code, and the maximum what you can pay is 37%. As you can see, the tax rate fluctuates based on the political party, based on the events, so you cannot really say like that will be our forever tax rate, right? So on the left side, you can see 2023 income tax rates, and I know it's like very hard to see, but I will tell you, in order for you to pay 37% tax rate, your net, right, taxable income should be over 578,000 for the single taxpayer, and for the married taxpayer, it should be over 693,000. That's where you pay the highest tax rate, 37. Why is this important? Because when we will move forward, then I'll talk about it. On the right corner here, it's our wonderful states. The highest tax rate, guess in which state? Yeah, everybody knows that. Don't move to California. If you're from California, I'm sorry. So 14.63%. Colorado pays 4.55%. Pennsylvania, Ohio, New York, not favorite states, because besides having a state tax, they also have a local tax. So you have to file 3 taxes. You're filing federal, state, and local. And then we have a state, which is 9 states. This is, you want to keep in mind if you're planning to move. Those states don't have an income tax. There are Washington, Nevada, Wyoming, South Dakota, Texas, Florida, Tennessee, New Hampshire, and Alaska. I will say that it's on an individual level, but if you own LLC or you own a corporation, like for example, Texas has the corporate tax filings requirement, not for the individuals. Okay? And so, who's controlling it? There's nothing. Okay. Okay, regarding the corporation, if you look right here, the corporate tax rate went from 1%, which I'm sure all of you will love that tax rate in 1910, although it was very hard to open the business at that time. Then it went to 52.80, again, to pour money into economy. And then it went to 35%, and it stayed for a long time. And then it didn't move in 2017. It was much before, too. 2018, when, again, Trump did the revision, reduced the corporate tax rate to 21%. This is very important to remember. We'll talk about later. Remember, the individual tax rate was the highest was 37%. Corporate tax level, 21% right now. What is the small business? I know, like, often when I've talked to business owner, they say, oh, I'm a millionaire, or I make $2 million. Well, I have a bad news for you. Small Business Administration sees you as very small business. With that said, if you are in the real estate and you're a contract, like you build houses like Vito, right? If you make less than $45 million, you qualify for Small Business Administration loan. You can apply through them because there is a special programs through SBA that you can obtain for your business. Before you go to bank, look which bank participate with the SBA. They can help you get the better rates. SBA provides special funding for the small businesses. If you're, like, I know a lot of you guys here in the residential remodeling business, if you make less than $19 million for your business, you're considering being a small business. If you're in the manufacturing, as long as you have less than 500 employees, you're considering small business and qualify for special financing. Okay, the most important part, what you can do for your business, is to choose the right structure for your business. There is, I just listed 5 most common business structure, but there is much more. The sole proprietorship, LLC and LLP. LLC is limited liability company. LLP is limited liability partnership. C corporation and S corporation. Depends on which structure you're going to choose. That's how you're going to be taxed. And I'll talk about the difference in the future, later. So who is the sole proprietor? Sole proprietor, it's you who operates by themselves. Typically, it's a one owner. And then you did not form the business with the state, so you don't have additional filing with the state, right? And you cannot have a partners unless you're married and filing joint tax return. Then you can do the joint venture. What does the joint venture means? Means that you and your wife, or you and your wife, will gonna split your income and expenses exactly 50-50 and file 2 Schedule C's on your personal tax return. Why it's important for Slavic people? Often, wives helps a lot. Like our business owner said, wives was helping doing the work for them, but the income was always reported under husband's Social Security. Guess what happening? Wife is not getting any pension, doesn't contribute anything in their Social Security. So when they retire, they have nothing. They can qualify for SSI maybe. Doing that joint venture and splitting the income helps both of you contribute income, into Social Security and Medicare. Sole proprietor, unlimited liability. You personally own liable for all you do. Meaning your personal assets also liable. If somebody is suing you, they can take your house for your actions. It's again simple taxation. Not all banks see you as a credible business. You will have to prove them that you're a very credible business. You show year over year very good profits. LLC. Когда-нибудь научусь пользоваться этим iPad'ом. Usually used to this kind of stuff. Limited liability company. It's a very common business structure that chosen by many people because it's very cheap to form. Not much need to be followed. The most important part of this, it does protect the owner from the litigation. And also, LLC is one of the few business formation that you can choose what kind of tax strategy you're going to choose for your business. So you can be treated as a sole proprietor. You form the LLC for legal reason, yet you're filing Schedule C on your personal tax return. You can also have a partner and file Form 1065, which is partnership, you can elect to be treated as a C Corp, or you can elect to be treated as an S Corp, and I'll talk about it a little bit later. What is the difference between LLC and LLP? Well, LLP, you have to have a partner. If you don't have a partner, the LLP get dissolved. And it also protects partner from the negligence of the other partner. There is only one form of taxation, partnership, and the cons for the LLP is not recognized in every state, and there is a limitation of a business, what you can, what kind of business you can own. Let's go to C corporation. People usually think C corporations for big corporation. It's not true. If you form Inc., let's say like our business is Makarim Business Consulting Inc., by default, I have to file Form 1120, which is subject to corporate tax. If I have LLC, I also can choose to be treated as a C Corp. C Corp also has the ability to be, I can elect to be treated as an S Corp. The biggest cons that everyone knows is the double taxation, and I'll talk about this later. The pros here, you can have unlimited shareholders, and your shareholders can be a foreign company. So it's S corporation. You cannot, this is the most common mistake that people think, that S corporation you form with the state. You cannot form the S corporation with the state. S corporation, it's only election for tax purposes. To be treated as S corporation, which is meaning it's a pass-through, so you're moving money from the corporation into personal tax return, that it's not subject to self-employment tax. I'll talk about that later. This is very common for small businesses. I will tell you, it's one of my favorite form of businesses, but I will tell you it's not always. It depends on your income level. With the S corporation, cons is you cannot have more than 100 shareholders. So it means S corporation cannot become a public. And all shareholders have to be either US citizen or resident alien. They have to be legally here. Foreigners cannot form the S corporation or elect the S corporation. And again, it's also restricted to certain professions. Like if you're in an insurance business, you will not be able to elect that. And again, international sales will not gonna work for this. My video is not working here. Again. Oh. Yeah, I just wanted you guys to see that. So just right now we understand what is the different types of structures we have. So I want to jump into actual example, visual. I know I'm a very visual person, and most of the people are visual, and that's how they can connect stuff. So I took, it's still not taking it. Okay. So I took LLC as a form of, let's say I form LLC. I can choose to be as a sole proprietor. I can choose to be partner. And I also have, in the next slide, C corporation and partnership. S corporation. As you can see, I took the scenario where, let's say, you making, it's not negative. So it's a $50,000. That is your net profit. I started with the low. This is, let's say you just started your business, right? So you need to understand. So your net income, $50,000, right? That $50,000 is subject to self-employment tax, which is $7,065, 15.3%. Remember, that goes to your Social Security and Medicare. That's your pension. Then you have a federal tax, which is $2,909 on the $50,000. So the total tax is $9,974. Okay? Partnership. The difference in the partnership, there is a reason I selected general partner. If you're a limited partner, you don't pay taxes on the net profit, self-employment tax on the net profit. You pay taxes only on the guarantee payment. Guarantee payment is what your corporation agreed to pay you no matter what, right? If you are general partner, you pay self-employment tax on guarantee payment and net income. And for this scenario purpose, I wanted to make sure on the personal tax return you will have a 50,000. So here you have a 25 guarantee payment and a portion of net income, because remember, partnership, you have to have a partner, right? So 50% goes to you, 50% goes to the partner if you have a 50-50% partnership. So your tax outcome going to be exactly the same as a sole proprietorship. I'm not talking here about rental properties, okay? The rental properties are treated a little bit differently. If it's a passive income, it's treated differently. So let's go to C corporate. In this case, again, 50,000. On the 50,000, you're going to pay 21% taxes, right? Flat rate on the tax return. And then let's say you distributed 25,000. So usually distribution from the C Corp comes as a form of dividends. So on 25,000, you're going to pay additional personal tax, which is 1,121. What it means, on 25,000, you twice pay tax. You pay 21% here, and then you pay it here additionally. So that's where double taxation happened, and your tax combined tax would be 11,621. If you took all of it out, then you're going to pay on the 50,000 additional taxes, and so basically your double taxation happened here, right? So then you get the S corp, right? So one of the requirements on the S corp is you have to have payroll. You have to pay wages to yourself. And the reason behind, and I will tell you, 80% tax return that come back to me from other preparer missing the wages, like it was not explained to a client. The reason you have to have a wages, because S corporation is not subject to self-employment tax. And so as our wonderful government wants to, we need to contribute into Social Security, so at some point they will pay back to us, right? Maybe. Maybe. Yeah. But as you create wages, right? Like as you start doing payroll, there is a payroll tax. That's, I calculate rough number based on the Colorado state, because payroll, what it includes in the payroll tax? Unemployment, right? Insurance. The good news, if you fire yourself, you can collect the unemployment, right? And then of course I took the $900 as a payroll expense. Payroll expense meaning that you will have to pay somebody to run the payroll for you. In this case, I took the fastest and cheapest is the QuickBooks, right? So you will pay in a year $900 for the payroll processing, right, for one person. So your income was reduced by your wages, like not your income, S corporation income was reduced by the wages, payroll tax, payroll expense. So your the S corporation income became $21,711, but on your personal tax return, you will have $25,000 from your W-2 and $21,000 from K1, the pass-through entity, to your personal tax return. So no self-employment tax, right? Payroll tax on your W-2 on the $25,000 would be roughly $1,913. Okay? Federal tax on your tax return will be $3,203. So if we combine just this, it becomes $5,116. But if I combine this plus this, the tax would be $7,505. And as you can clearly see, S corporation is the winning strategy in this case. This is where most, like, if I talk to the business owner who've been in the business for more than 10 years, they know that. If I talk the business owner who just started, they don't know that. So that's why it's important to understand. But let's say you went to the other stage where your income went significantly higher, and in this case, I'm taking scenario. This is net income. It means that after all of your expenses, you generated $100 million, and then you had a bunch of expenses, and so here you go. You came to 500,000 net. Straightforward for sole proprietor partnership. This is your tax, right? As corporation, you pay payroll, and again, I'm not taking all the expenses, like just for simplicity reason, and just to fit in one page. Your tax 160. This is where it's super important to understand. This is why I told you, remember 21% and 37%. Now you are generating 500,000, but you only pay to yourself 100,000. This means 100,000 is subject to just the income tax, right? On your personal tax return. You pay 21% right here, and income tax 100,000. You paid only on 100,000, which is not 37%. When people ask how does Elon Musk is not paying so much in taxes, this is his strategy. He takes dividends, and you can control your dividends, how much you're taking. If you don't need it, if you have other income, you don't have to take it. You can leave it in the company, pay 21%, and take it when you need it. Okay. So, what is the best tax strategy? And I'm just going to read fast, just for the time constraint. Super important. It is make sure that you're keeping tracking all of your expenses, income, investment. This will help you to take advantage of certain credits. And actually, when you go and do your tax return, you will be able to take all the necessary expenses, like write-offs. The number one why people cannot write off certain expenses just because they're missing receipts. That's why it's there. Aliens usually taking. And my favorite one when I ask client, how much did you spend on the certain expense? They look silly. I always look at my ceiling and I think like something is written there, but it's never there. Anyway, you do need to understand accrual versus cash because this is how you can recognize revenue. Accrual, for example, you recognize revenue before it even came to you. You did the work, people didn't pay you, but you already recognize that revenue and you recognize your expenses in the same way. Cash, it means when I paid, that's when I recognize my expenses, and then I recognize revenue when I receive the cash in my bank. Then if you're selling merch or selling something, remember FIFO and LIFO. FIFO is first in, first out. LIFO is last in, first out. This is how this affects your cost of goods sold. First in, first out, meaning I am assuming that the oldest inventory item are sold first, and the last in, first out, I'm assuming that last inventory item that came last is sold first. Why it's important? Sometimes in the industry, when certain items become, it's cheaper, then it's better to take the first in than first out, something that was sold before. Bought before, and the last in, first out. Let's say I bought a granite, and it's much more expensive right now than it was before. So if I choose the LIFO, it means that I can sell it. I can recognize more expensive. But if you choose FIFO, you have to declare to the IRS that you are switching from FIFO to LIFO. Okay, so it's not just like, oh, this year I'm going to choose FIFO, next year I'm going to choose LIFO, right? Understand the depreciation versus expense. Depreciation, if you're taking item and depreciating over a year. IRS has defined different items, and like for example, truck should be depreciated, semi-truck should be depreciated over 3 years. This is number one mistake. Typically, pickup trucks, small pickup truck, Tacoma, Dodge, whatever you drive, they're over 5 years depreciated. If it's small electronics or small tools, 2,500 and less, you can expense it. But sometimes you want to depreciate it. The reason behind, if you're already at the low income, you might want to just depreciate it. Understand your expenses. Someone here asked a very good question regarding where can I find this information. Remember publication 535. You go to irs.gov, publication 535. It's what they say it's a Bible for business owners. So you can just go and read it for yourself. Hire your children that it's under age 18, okay? Take advantage of a tax credit. Plan for major purchases and investment. Don't wait December to buy something. Because that's number one when the purchasing begins December 1st and everybody says like, okay, what should I buy so I can write off, right? Utilize retirement plan. Super important to do that. Not everybody knows that they can invest in SEP IRS, Simple IRS, or IRA, or 401ks, solo 401ks. This is for small businesses. Pay estimate tax. If you owe more than $1,000 at the end of when you prepare your tax return, you're going to pay penalty on the outstanding amount. If you pay estimate tax, you can reduce that. And why would you want to pay extra money to the IRS? Stay informed about tax law changes. If you go to irs.gov, you can subscribe to e-news for small businesses. If you subscribe to this, it's awesome tool. They provide a lot of information for you. And if any new tax law comes up, then you can use this. Yep. Plan for future. Many business on the panel owners said that you need to plan for future. Number one, whether people fail, they decide to sell the business today, but then 2 years in a row they was writing off everything. And so business, like the potential buyer comes in and they say, well, your business isn't worth anything. So you need to plan for the future. You need to pay, if you want to pay as little as possible this year, for example, make sure you are working with your accountant to, talk to them and see what you can do, because there's certain credits that you can take. If you're planning to borrow money, make sure you're taking right deduction. For example, you can write off $2,500, right? As an expense, you can expense it. But if you take as a depreciation, that's add back for the loan purposes. So certain deduction actually can help you to even borrow money. Okay. Okay, final takeaway. This is how to eliminate risk regarding the audit. Consider the form of business. It's super important. Schedule C, based on the previous statistics, is actually get audited the most. Sole proprietorship. S corporation is audited the least. Treat small business taxes as a year-round responsibility. You need to make sure you are paying accurate estimates. Because that's when the IRS has to send you a letter with the penalty and interest, somebody goes in and sends you that. So somebody is looking into it, so you don't want anybody to look at that. Report income accurately. IRS compares the income you reported to the income reported by others, like for example 1099s, W-2 that reported under your company name or under your social security, and they compare did you reported everything correctly. Be diligent with the record keeping. It's super important. Like again, make sure you keep all the receipts. You can sleep well when you have a good records. Classify employees and contractor correctly, or it can trigger the state audit. It will eliminate state audit by having the right employee structure. File on time. If you always file your return on time, that helps to eliminate audit. Late filings can draw unwanted attention.
Be careful with deduction. IRS compares your tax return to the industry norms. And if your industry norms is, let's say, you have expenses of 10,000, but while industry norm is like 1,000, 2,000, that can be a red flag. Be cautious with the home office deduction because that's one of the highest audit items. Maintain a separate business bank account and a personal bank account. Be honest and transparent. Never attempt to deceive or hide information from the IRS because IRS knows all. But it is important to know that audits are random and sometimes you cannot avoid. Some audits are not random, others are random. Okay? And, sorry, I'll go back. I wanted to finish with the verse from Bible. It's written in Romans 13:6 through 7. This is also why you pay taxes, for the authorities are God's servants who give their full time to govern. Give to everyone what you owe them. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect. If honor, then honor. Thank you.